Markets plunging after a surprisingly hot inflation read from New York City. For our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Ferro. The countdown to that open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
We begin with the big issue, more fuel for the Fed.
The CPI report.
U.S. CPI index.
The key is going to be not so much the headline.
We need to know, have we reached this peak inflation scenario yet or not?
The risk here really is that inflation becomes unhinged even further than what we've already seen.
In the face of 5, 6, 7, 8% inflation, you still have a Fed funds rate that's under 1%.
So from the Fed's perspective, the Fed is still well behind the curve.
You have to bring at least up to, let's say, 3, 4, 5%.
The Fed will be raising rates, no chance of a pause.
Hawkish path for the Fed is still most likely.
Yes, we're squarely in a slowdown.
We have made the turn on employment.
There's a lot of tightening priced in.
Inflation is so front and center.
This will do nothing to deter the Fed from where they're going.
That is the expectation for the Federal Reserve as we take a look at currently being priced into the market. Full 50 basis point rate hike, not only this month, but also next month and then in the September Fed meeting. JPMorgan's David Lebovitz was expecting it to be peak inflation a couple of months ago, yet here we are staring in the face of a new 40-year high. What did you make of this inflation rate?
So the headline number obviously came in hotter than expected. You look at what drove that, and energy was a big part of the equation. And so, to us, we're really much more focused on the core figure. And I think if there is a silver lining to this, it was arguably the stability that we saw in core. In terms of the various components, the story here is still the same. You have food and energy contributing to elevated headline inflation. You have the big move that we've seen in home prices continuing to support the core figure. I think the core number probably would have been a smidge lower had we not seen that pop in auto prices. But, look, I think that the reality here is everybody knows that inflation is not going to be transitory. Everybody knows that inflation is going to be sticky. And I think the question that we need to be asking ourselves is, what does this inflation mean for purchasing power and consumption, particularly during the second half of this year?
Exactly where I wanted to go. Well, a lot of people were parsing between the numbers. You strip out energy, you strip out food, and you start to see it's everything else as well, whether it's airlines, whether it's cars, whether it's whatever else people are buying. We are seeing real wages continue to head further negative. They are not keeping pace with inflation where it is now, currently on a weekly basis, negative 3.9% in terms of real wage inflation. And that's the weakest going back in data to 2006. How much will that crimp consumer appetite, David?
So we think that it will. And, one interesting thing that we've observed in some of the data from the Chase side of our business is that there's already been a significant shift in spending, particularly amongst lower income individuals, away from discretionary items and back into core, right? They're spending more on food. They're spending more filling their cars, heating their homes, so on and so forth. This has also been reflected and highlighted in a number of retailer earnings reports over the past couple of weeks. And so I think what's going on here is you're going to see this shift in consumption. We know that the consumer is healthy. We know that the consumer has excess savings, which can allow them to withstand this food and energy and commodity shock more broadly, but they are beginning to shift what they are spending on. And I do think that that's going to lead not just growth to slow, but inflation to come off the boil here during the second half of this year. Again, that headline number is very noisy, given what's going on with energy prices, and anybody who drives a car knows exactly what's going on with energy prices. I think watching that core figure is going to be key for determining what the Fed is going to do. And we do think that core figure could decelerate with a bit more pace during the second half than people may be thinking in the wake of this morning's report.
That headline figure is noisy. It's also what people are feeling with that new 40-year high for inflation. And even if the Fed eventually gets a sense of patience from that core CPI coming down, right now expectations are high that we are going to get 3 consecutive 50 basis point rate hikes. Michael McKee parsing through all of this. Mike, what are you seeing?
Well, Lisa, you got to go back to December 1981, as you said, to find the last time we were dealing with inflation this high. And remember, they've changed the calculation since then to make it come in a little bit lower. So 8.6% is definitely going to be considered bad news. And while you guys were just talking about the Fed looking at core inflation, for Joe Biden and the administration and the average American, it's headline that matters because it's gasoline and it is food. And gasoline prices were up 4.1% in May, 48.7% on an annual basis. And the bad news is in June, prices have gone even higher. Most states now over $5 a gallon. Food at home up 11.9% over the course of the year. Owner's equivalent rent, that's one that's really got to be watched because up 0.6%. That's higher than it has been. And that pushes up home prices 5.1%. They're a third of the CPI. And used cars, we thought they were going to go down. They didn't. And they're up 1.8%, 16%. Airfares, everybody knows, have been up. So the components that have been driving inflation haven't really gotten any better. We've broadened out a little bit, and that is kind of bad news. And what you look at when you see what's happening with gasoline is the percentage of what you're taking home, your paycheck, your earnings, your spending that is going to gasoline has risen to an 8-year high and will probably go up even higher than that when we get the June figures. But as far as the Fed is concerned, they're going to watch. The markets are repricing, as you said, now 50 basis points for the next 3 meetings, but there are 3 CPI reports ahead. So we shall see whether we see any relief at all in the coming months. It's hard to see it coming with gasoline given the seasonality, but at this point, the Fed can keep raising rates, but can they tame gasoline and food prices? That's one area they don't have much power over.
Mike, that's what a lot of people are pointing to. Thank you, that the Fed cannot drill for gas, or drill for oil or refine it into gas, and they cannot plant crops. Mohamed El-Erian was weighing in on the Fed's approach to taming inflation just yesterday. Take a listen.
Now it's about minimizing the mistake, and they're going to have to make a choice and stick to it. The worst thing is a flip-flopping Fed, a Fed that hikes rates and then pauses in September, then starts hiking again and then pauses again. That would just mean that stagflation would persist much longer than it needs to.
Others say we're already in a recession. That's the view from Bank of America's Michael Hartnett, writing the following: we're in technical recession, but just don't realize it. In short, inflation shock not over, rates shock just starting, growth shock coming, no release valve from peak in yields, bear market rally to consensus. David Lebovitz, still with us. Do you agree? Is that what you're seeing also, that the bear market rally is basically the consensus right now, which means that perhaps we are heading toward a bit of a more weakening situation?
So, I think what's so interesting about the current environment is that there's lots of bad news, and everybody knows what the bad news is, right? Inflation's elevated, gas prices are high. It looks like growth is decelerating with a bit more pace. We had a negative growth quarter to kick off the year. What's so interesting to me, though, is that when you look at what's going on in the economy, when we go through the airports, when we're in various cities seeing clients, things are buzzing. And so if there is stagflation, I don't really see the stag. And I frankly think that, this lower rate of growth, and we're not in the camp that the recession has already started. We think that risk is much more concentrated in 2023. But if growth has come under pressure, which arguably it has, this is what we need to see, right? This is what needs to happen in order for inflation to come in, because effectively inflation is economic sweat, right? You get inflation when an economy is running too hot. The economy was running too hot into the end of 2021. The deceleration that we're now seeing is going to help with the inflation problem. And so I'm inclined to start taking the other side of this trade. I do think that there are some false dawns in the equity market ahead of us, but I do think that more clarity from the Fed, which will come over the course of the next few months with those 3 CPI reports that Mike mentioned, more clarity from the Fed is what's needed for the equity market to find its footing and potentially resume an upward trend in the second half of this year.
How are you taking the other side, David? What exactly are you buying, given the fact that, frankly, the index has really defied some of the noise underneath at the specific security level?
So, the problem with the benchmarks here in the United States is that they're heavily weighted towards growth. And so go, the big mega cap tech names. That's what you're going to see from the S&P. We continue to be interested, and this is where we started the year, in those types of businesses, those sectors, those industries that have operating leverage. That tends to be more of a value trade. We like the industrials. We like the materials. We think given what's going on with the energy sector, particularly with the lack of refining capacity and where the crack spread is today, that there's probably some juice left in that energy trade. And so, to us, the question isn't necessarily do we run away from equities. The question today, and I think Jonathan Golub was saying this earlier on, the question today for us is which equities do you own? Because even with a 10-year at 3%, that's not a rate of return that's going to be sufficient for most people to accomplish, their longer-term goals.
When we talk about margin compression and Target and some of the other retailers that have really highlighted how much and how quickly this is happening, have we accurately priced some of the earnings revisions downward that a lot of people are expecting in the second quarter, that we're expecting to get rolling out over the next few weeks, given the fact that, frankly, consumers cannot absorb all of the price increases and they're grappling with higher gas prices, higher wages, and the like?
So I do think the idea that higher prices can continue to be passed on, we're getting to that breaking point. We always kind of remark internally that, look, the cure for higher prices is higher prices. And so obviously this inflation is beginning to weigh on demand. What I would say about the margin issue more specifically is, there are basically three things that you can do to defend your margins. You can pass on those higher prices, which is what we've seen so far this year. You can focus on productivity, which I think is going to begin to show up more across the various earnings reports. You saw a surge in investment spending coming into this year. Obviously, that's taken a pause, but automation and efficiency still front of mind for corporations. And then finally, there's the labor market angle. And, I wouldn't read too much into what happened with claims last week. We think that bounce was more a seasonal factor than anything else. But anecdotally, you hear about layoffs, you hear about hiring freezes. I do think that corporations are recognizing that the employment side of things may have been a little bit too far over its skis. You're seeing them begin to pull back. And really that cost management piece is something that we believe is underappreciated and may allow margins to prove more resilient than a lot of people are currently penciling in.
David Lebovitz sticking with us. If you're just joining us now, we just are coming off a half hour ago. The hottest inflation read for consumer prices in the United States going back to the early 1980s, a 40-year high, as everything from gas and food, but also with rents and airlines started to increase in terms of the pace of rate gains. Right now, with a look at some of the stocks that are getting most affected, here's Abigail Doolittle.
Well, Lisa, on this shock CPI report, we have stock futures down very sharply, down more than 1.5%. On the week, the S&P 500 E-mini futures on pace for the worst week since January, down nearly 4%. Not surprisingly, on this report and the massive flattening on the yield curve, all parts of the yield curve, in fact, the 530 inverting briefly, but it's that two-year yield that, as you know, backing up more than 10 basis points, weighing on big tech. Valuation fears down 1.9%. It's also interesting, though, you don't have the rest of the yield curve or you don't have some of the other yields, they're flat. You have banks down even with the yield curve flattening, not surprisingly, down 2.1%. American Airlines, you were just mentioning that airline inflation down 2.3%. And then Target, they, of course, have had a tough time managing inventories. Inflation, a piece of that story. That big box retailer down 1.3%. A rough start to this morning for sure, Lisa.
Abigail, for sure. Thank you for keeping track of it. We'll keep checking in with you. Coming up, the Biden administration trying to tackle supply side inflation in the face of what we just saw from the CPI report.
We were paying $3,500 a container in 2020. And then by September, October of last year, we were paying upwards of $20,000 to $25,000.
Yeah, it's outrageous.
Outrageous.
Pain at the ports adding pressure to already surging prices. That conversation still ahead. And as Abby was talking about, we are seeing stocks plunge in the face of higher and yet higher inflation in the United States. This is Bloomberg.
One of the big reasons why prices are going up is the cost of shipping things across the Pacific in particular. Major ocean line shipping companies who ship from Asia to the United States. These companies have raised their prices by as much as 1,000%. We've got to change this. We've got to bring down prices.
President Biden's scheduled to visit the busiest port in the country later today. This as the White House keeps a close eye on labor negotiations with dock workers. One trade group president saying a strike could, quote, certainly move us into recession in a matter of weeks. So the president has got to calculate this very carefully. Joining us now from the Port of Los Angeles is Bloomberg's Ed Ludlow. Ed, what do we actually see President Biden being able to do, not only about the labor situation, but really how much that bleeds out into the supply chain disruptions fueling some of this inflation?
Yeah, I think it's not a question of what is happening, but potentially what could happen. We care. The reason I'm here, the reason the president is coming on Inflation Day to the Port of Los Angeles is that an impasse between the Longshoremen and Warehouse Workers Union and the PMA, who operate the ports on the west coast of America, could lead to an impact of supply of containers. An impact to the supply of containers could raise prices. If you look into this Bloomberg terminal chart that I've got, we're down around 27% from September, when 40-foot container prices peaked due to inefficiency here at the port. And the president's response was to say to Labour Secretary Walsh, Transport Secretary Buttigieg, you two need to get there on the ground and get this situation resolved, not just in terms of the talks between the unions and the operators, but also to help in easing the supply chain concerns that we see. That's the chart you're looking at on your screen now. We note that in the inflation print, we are talking about rent, food, gas prices, and those are slightly separate to consumer goods. But the other thing that's happening around the world, of course, Lisa, is that China's economy is reopening, and that there has not been a flow of goods coming into this port in the same way, perhaps, that we saw between September and the first 3 months of this year. So they are bracing for higher volumes, particularly in the month of June, where retailers here in America take very proactive stances to look at inventories ahead of the holiday season at the end of 2022.
Ed Ludlow, thank you so much for your great reporting there. And catch Ed's interview with the executive director of the Port of Los Angeles coming up at the top of the hour, a key issue as we grapple with many inputs to this inflation backdrop. On that point, Henrietta Treyz joining us of Veda Partners alongside David Lebovitz of JPMorgan. Henrietta, how much can, frankly, this administration or anyone in the political sphere do to offset some of these inflationary pressures, considering how multifaceted they are?
Well, I think there are a couple of things. Just to stick with the port issue while we're on it at the moment, if there's one administration with a built-up well of goodwill from labor that can negotiate the upcoming issue that we're going to see in July, it's the Biden administration. You know, the president is there right now, but more importantly, I would say Ambassador Tai was there from the U.S. Trade Representative office earlier this week at the Summit of Americas, but we've seen their focus on labor negotiations in the past with the Supply Chain Crisis Council that they convened last year that linked workers with the ports, with the big box retailers. They have a residual well of goodwill that I think diminishes my anxiety internally about whether those labor negotiations will blow up. I think if anybody's administration can handle it, their focus on labor in the past couple of months strongly makes an argument for this being resolved well in advance of the uptick in China port containers coming over. On the other side, in terms of what the administration can do on inflation, obviously that's not in the hands of Congress or the White House. But they do have a bill that is rapidly gaining traction. We'll see if it can come to fruition. We tell our clients it's a 50-60% odd situation at best right now, but it's targeting the tangential pieces of inflation, which is going to be not providing domestic stimulus to individuals through things like the child tax credit or the earned income tax credit right now, but things like domestic alternative energy sources, providing funding to those, trying to tamp down domestic household healthcare costs, prescription drug pricing. So as we see inflation continue to ripple through the economy and wreak havoc, and you're seeing wages actually come down in this last month's print, you can do things tangentially to offset household costs. I think that's where they'll focus.
And David, this really speaks to the question that you were talking about, the expectation that we will see inflation start to roll over, at least on a core level, when you strip out energy, when you strip out food, because of some of these areas that are softening a little bit in the good way. However, firms are still anticipating squeezed margins. Morgan Stanley had a global supply chain survey talking about the fact that on average, corporates expect margin declines of about 2% due to supply chain changes. U.S. companies were more inclined to consider onshoring. Others in Europe and Asia more likely nearshoring. How much is this a persistent headwind to margins? This idea that it's not just the inflation, it's also structural changes that have come about as a result of where we are right now.
So the supply chain issue is obviously a very interesting one. And I keep reminding people, companies were rethinking what their supply chains looked like before COVID. We were in the midst of a trade war with China in the run up to the pandemic. And you already saw corporations beginning to take action to relocate and diversify their supply chains globally. When we think about this issue of is it deglobalization, is it slowbalization, we're much more in the camp of slowbalization. We think that businesses are going to be more thoughtful about where their supply chains are located, where they're doing business. It's not necessarily going to be about seeking out that lowest cost of labor and production, but the idea that this whole thing gets completely thrown into reverse to us is just a bit of a stretch. And the other point that I think it's important to recognize is a lot of our conversation this morning has centered on the supply side of the economy. We've talked a little bit about demand, and this is what makes the inflation thing so challenging is higher rates don't fix the supply chain. Higher rates don't bring workers back into the labor market. Higher rates weigh on things like housing, and you've already begun to see that play out. And so the question for me, as we think about the Fed, which is really in the driver's seat here, is can they differentiate between the inflation they're able to control and the inflation that they are unable to control? Because if they fail to differentiate between the two, that's, in our view, what could potentially crash the plane at some point in 2023.
David Lebovitz, we all hope that they manage a soft landing, frankly, because of what we're seeing around us of JPMorgan. Henrietta Treyz of Veda Partners, thank you both so much for taking the time. Coming up, the morning calls and later big tech under pressure after U.S. inflation accelerates to a fresh 40-year high. That conversation still ahead. We are seeing those declines deepen throughout markets, not just the big tech names after as hotter than expected inflation read boosted expectations for Fed rate hikes. This is Bloomberg. This is Bloomberg Markets, the open, taking a look at losses deepening throughout the morning after a hotter than expected inflation read led by big tech. Time now for our morning calls. I'll look at some of the analyst recommendations on Wall Street this morning. First up, MoffettNathanson downgrading Electronic Arts to neutral, $147 price target, seeing limited upside following the stock's recent rally. Next up, Goldman Sachs downgrading Netflix to sell, $186 price target, expecting a weaker macro environment and consumer spending. And finally, JPMorgan upgrading Spirit Airlines to overweight, talking about a tactical trade idea on growing M&A hopes. Coming up, we get the market open. This is Bloomberg. This is Countdown to the Open. I'm Lisa Abramowicz in for Jonathan Ferro. Moments away from the start of trading, and that sell-off is persistent. NASDAQ leading the way down, was down as much as 2% and beyond. Now down 1.9%. We can see the S&P down 1.7%, 39.48. We have gone below that 4% level. Meanwhile, if you take a look at the bond market, that is what is driving the action. We are seeing two-year yields surge to the highest levels going back to 2018. That's leading the way. We are not seeing the same kind of gains in the yield loss in the price of the longer end. That flattening yield curve is really signaling the concern about growth, also signaled by crude falling to 120 basis points. Joining us now with a look at the stocks moving at the opening bell, here's Abigail Doolittle.
Well, Lisa, on this brutal action here on this shock CPI report. We do have stocks plunging, as you were just pointing out. In fact, the S&P 500 on pace for its worst week since the end of January, down about 4%. This, of course, on these rising inflation fears, a fresh 40-year hit. This, of course, is hitting big tech because it means valuation is in concern. But you were mentioning the yield curve. It is flattening. In fact, the 530s were inverted briefly. The two 10s are below 10 basis points. That's weighing on the banks. Big banks down in a big way, down more than 2%. United Airlines and other airlines down sharply on inflation fears, price increases, and what will that mean for the future. And then, of course, we've had some of the big box retailers. Target is down sharply, but Walmart is also down sharply. These companies have a hard time managing their inventories amidst these inflation fears. A rough start here for stocks, Lisa.
Abigail, thank you so much. A hotter than expected inflation print. Also taking the bite out of the tech sector. Bloomberg's Taylor Riggs joining us now with more. Taylor.
Yeah, and Lisa, I think what's interesting is Abigail was talking about the tech sector. We're also going to fold that into some of the discretionary, right? It is all about that high CPI data. Goldman Sachs out with a few calls this morning that are really interesting. One that you mentioned, Lisa, in your top calls when it comes to Netflix. We're taking a look at Goldman lowering price targets on companies like Airbnb, cutting Netflix, Roblox, eBay, right? All on sort of macro concerns when you think about tech, but you also think about the consumer-facing technology companies, right, in the midst of this higher CPI data. I think what is so interesting is take a look at year to date. We always thought that sort of the consumer staples was this big defensive play, and indeed, the discretionary at the bottom of your screen, that's off now 28%. When you think about how consumers are going to cut, where they're going to cut, what is really defensive in this environment, what is not. So it really has been that discretionary at the bottom of the screen that continues to be hit the hardest when we think about some of the higher inflationary costs that are underway. Flip up the board, and well, there's no better chart to show this than sort of the relative outperformance of how we're thinking about staples, how we're thinking about consumer discretionary. And that is really all of sort of these fintech stocks. And then, of course, if you want to pull up the terminal chart that we have there, all about the consumer defensive. And Lisa, certainly that story continues today.
Taylor Riggs, thank you so much. Strategists growing concerned about the outlook for corporate profits. C-suite confidence tumbling to a 6-year low amid surging inflation and tightening margins. Kaylee Lines joining us now with growing earnings recession fears. Kaylee.
Yeah, Lisa, typically when you see confidence rolling over like this, it indicates that profits are going to take a hit about 3 to 6 months out. And of course, it's not just CEOs that are sounding the warning. Analysts are too, in that they are cutting their earnings estimates. We are seeing those earnings revisions moving lower. The Citi Global Earnings Revision Index actually has been in negative territory pretty much since March. And of course, the revisions have been more dramatic for certain groups of stocks, like growth stocks, the kind that Taylor was just talking about, which have been underperforming due to higher rates and inflationary pressure. Bloomberg Intelligence says that actually since mid-April, growth stock earnings estimates have slid by 7 percentage points for the second quarter. And they've been cut for the second half as well, down to just 3.2% in the third quarter and 4% in the fourth. And of course, all of this as profits are under pressure, in part due to the burn of a stronger dollar. That's what we heard Microsoft talking about recently. It's significant when 40% of S&P revenues come from overseas. But more broadly, it is the inflation problem. Once again, on display today, companies facing higher costs on everything from raw materials to freight to labor. And you put that all together with a consumer that maybe is starting to change its behavior in the face of these persistently high inflation pressures, and the ability to pass those costs on gets harder. So it raises the question of, if we haven't seen peak inflation, Lisa, does that mean that we have seen peak profit margins?
Kaylee Lines, thank you so much. And you start to see some of the warnings on a strong dollar, typically when other things also are not going perfectly well. Dan Skelly knows as well of Morgan Stanley, heading their equity modeling portfolio for them there. You guys have nailed it when it comes to the rate fears turning into a slowing growth fear kind of environment, which is very much where we seem to be. How does what we just saw, the CPI print, play into that narrative?
Good morning, Lisa, and happy Friday, and I'll add happy summer to you as well on this volatile Friday. A few things to note. So this is actually fairly consistent with what we've been saying for the last 6 or 7 months, as you know, and we were, a bit lonelier at the end of last year, signaling a more cautious view, but our view on inflation, which was out of consensus and cautious a year ago, was also what informed us in terms of our defensiveness related to the market. And when you talk about the market, several of your guests have already highlighted it this morning, the size of tech and the size of growth in the market is obviously historic. And they also happen to be the cohort most susceptible to higher interest rates and higher inflation. So all of these calls were connected. And so frankly, what we're seeing this morning is just more confirmation of some of the caution that we had originally.
Dan, based on the components factoring into CPI, do you think that we've seen peak inflation?
I think what made me particularly cautious that we have not is some of the services data. So when you look at it, it's a dual-edged sword, as we know. I think COVID was a particularly unique recession in that many of the wealthier cohorts of the income scale did better. Frankly, they didn't lose work. They made tremendous gains for several years in the market recently until, this year. They've made tremendous money on home equity appreciation. And so they have tremendous pent-up demand to go out and travel. I'm very sympathetic to some of those travel comments earlier today as well. And so, I think when you see hotel, airline, medical costs, and some of these services, call it stickier costs going higher, perhaps we're going to be in this for a little bit longer, Lisa.
Famed investor Stan Druckenmiller was saying yesterday that the bear market has more room to run, saying, continue, that my best case is that we're 6 months into a bear market. For those tactically trading, it's possible the first leg of that has ended, but I think it's highly, highly probable that the bear market has a ways to run. Dan, I get the sense you agree with him, but how much? How do we gauge the scope of pain given the revisions upward of inflation and downward of growth?
Excellent question, Lisa, and this is really the key topic today. And, as we've outlined it, and Mike Wilson, our strategist, had outlined it, correctly, the first part of the bear was this inflation and rates and derating in the multiple. And we've seen that play out. Multiples in the S&P are off 20% or so year to date. The second part of it, in our view, is the earnings hit. Okay. And so we have seen, obviously, some blowups in some of those most acutely sensitive to over earning in the COVID period. So the retailers of the world who overordered inventory and maybe have a little bit of skew to that lower end income scale, who's getting particularly impacted by food and gas today. So we've seen that. We think that that basically broadens out a bit more to some other parts of the market. That being said, okay, we see this being limited to a multiple and earnings hit. We do not see a part 3 just yet of a broader economic hit. So, Lisa, to answer your question, yes, there's probably a volatile summer ahead of us, but we still don't see an economic contraction. And with that, you're probably going to be limited to maybe 5-10% further downside.
So when we talk about no recession or necessarily a hard landing, how does that feed into the Fed call here? Because right now the market's pricing in 2 more 50 basis point rate hikes at the consecutive meetings coming up for the Fed. And yes, they can't solve issues with drilling for oil or with planting more crops, but they can dampen demand. Where does that fall into this sort of softer outlook of yours?
So it's a super complex topic, and the way I would answer it, and I'll add to that, by the way, everyone's been talking about the Fed can't build a refinery, the Fed can't control the Chinese lockdowns. I'll also just add the Fed can't go down to Florida, knock on people's doors who retired the last 2 years and tell them to come back to work, right? We're dealing with many structural issues here at the moment. How does this all feed into our kind of softer landing, non-recessionary call, Lisa? We have to differentiate between the markets and the economy, right? And so when you think about it, a lot of the time they are related, but there are times where they diverge. And this is one of those times. We're going through this tremendously unique experience of removing unprecedented stimulus, emergency stimulus, right? And so that was never going to be easy. We haven't also, by the way, talked about as much QT, which is just starting really in earnest this month. The maturity roll-off really does accelerate towards the second half of June. So you're going to continue to see this market volatility. You're going to continue, we think, starting in July and maybe even extending to September. You're going to see earnings pressure on the cost side of things. On the dollar side of things, look at the dollar moving. This morning, you heard from a huge software component a few weeks back about their dollar impact. I believe Kaylee, referenced earlier the 40% of S&P from overseas. So it's more of a market event versus an economic event at this time.
Do you really buy that? People always start to warn about currency issues when everything else is falling out of bed as well. I mean, don't you think that part of this is a slowing growth story globally that's feeding into a lack of demand, and not just simply the dollar as a reflection of that?
So in terms of tech, I think they're unique in that, look, they've suffered the most, as we've talked about, because they're the most sensitive to rates. And so on the multiple side of things, yes, they've suffered. I would argue, however, Lisa, and I see companies and listen to companies all the time. I saw a dozen companies last week at a conference. The demand for tech spending, the services, the cloud, connectivity, mobile, digital transformation. Look, all of these things accelerated because of COVID. They were massively in demand before COVID. But if you were an industry or you were a company not prepared for a digital future, I bet you're investing heavily there too. And David, your earlier guest mentioned that as well in terms of the capital spend. So listen, I think it's going to be unique on an industry by industry basis, but I do think the tech earnings demand may be more resilient.
Where do you see earnings pressure not fully priced in? Which sectors of the market?
Listen, I think there's probably some room to go further down on the industrial side of things, right? So when you think about what's going on in Europe, what's going on in China, Asia at the moment, you know, and think about some of the pressures there, I think industrials and PMIs, frankly, have further to fall. Okay, so that's one area we would think about. Look, in terms of the defensive sectors that have worked, you've seen that kind of classic rotation to date in terms of utilities, healthcare, some REIT outperformance. The one area Mike and team has been a little bit more cautious on is staples. And so they are dealing, frankly, with the inflationary pressures probably most. Yeah. So that's another area, Lisa, where there's probably going to be more surprises in staples land this coming quarter.
To that point, 18 minutes away, the University of Michigan U.S. Consumer Confidence Survey. How important is that in determining your bullish or bearishness about consumer staples, about some of these more sensitive sectors?
You know, I think sentiment has been really dirt poor for the last couple of months, and it probably will continue to be that way, just given the inflation pressures, as we've alluded to, aren't going away anytime soon. You know, some of your guests have commented on pricing power, and to date, we've seen companies getting creative not only on pricing but also on packaging. And I, you know, certainly can detect some changes in some of the everyday goods and items that I certainly utilize, and maybe you have as well. And so they're trying to do every type of creative financial engineering measure to manage the bottom line. The question is, how long is that going to go on for? We continue to favor, from the equity standpoint, we continue to favor those global franchises with pricing, with brand equity, that are, frankly, winning share in this environment. And I'll just say one last thing, that are using technology and analytics to become more efficient. That was a trend going on before COVID. But like we've talked about, that continues to be incredibly paramount importance.
Dan Skelly of Morgan Stanley, thank you so much for being with us. Coming up, U.S. inflation surging to a 40-year high, adding yet another headwind to the airline sector. That conversation coming up next as we see those losses continue to deepen. The S&P down 1.8%, 39.45. This is Bloomberg.
Pricing is way up, demand has outstripped supply, and that has allowed prices to stay high. And, you know, are there going to be cracks? Are there going to be places perhaps where things start to, you know, reach their peak or come off their peak? Sure. But broadly, we're not seeing, you know, any discernible moment or timeline where it's like, oops, you know, come whenever, it's all going to fall off.
The Expedia CEO speaking about how inflation in America, which just hit a fresh 40-year high, is really crimping some of the consumer spending. Another confirmation of surging prices, turning up the heat on the Fed's rate hike path. For more, let's bring in Bloomberg's Michael McKee. Mike.
Good morning, Lisa. Yes, you have to go back to December 1981. The Grinch came down the chimney and brought inflation as high as it is now. That was the last time we saw anything like this. If there is a bit of good news, it's in the contained rise, only 6% in the core rate. And that's something we'll have to keep an eye on, because once again, food and fuel prices really drove the index higher. Gasoline prices up by almost 49% on a year-over-year basis. You don't have to tell anyone who's filled up their car lately that that's an issue. Home prices also are an issue. We've known that they come into the CPI slowly, and they're starting to pick up, and we have seen a big run up in home prices. The question now is, with the Fed raising interest rates and mortgage rates going up so much and home sales dropping, will prices drop or will they stay firm? That's going to be something that they're going to be watching in the future. A couple other surprises in the numbers today. Used car prices, people thought they'd go down and they didn't. And then airfares. This comes out of COVID. And remember COVID and its impact on the economy? The airlines are making up for lost time with airplanes packed and not enough crew because they had to let so many people go during COVID, and people still getting sick. So airfares up again on the month. They're up 37, 38% for the year. Now, one would expect that to start dropping, but it hasn't yet. Of course, we're in peak travel season now, so we'll keep an eye on that going forward.
Michael McKee, thank you so much. Some shocking statistics about how much airfare has gone up. Pricing spiking nearly 13% in May alone, not to mention the 38% year-over-year gain. Cowen's Helane Becker joins us now to discuss the airline industry, and this comes as we get a headline right now. Before we get to the inflation aspect, the CDC is planning to lift test requirements for travelers entering the U.S. This is being reported by CNN, and that you're seeing a reaction in markets for a lot of travel stocks. How big of a deal would this be for the travel industry, Helane?
Hi, Lisa. Yes, it's huge for the industry. We and others have been urging the White House to eliminate pre-departure testing for the better part of 3 or 4 months. We're the only country left to do it. There are workarounds. People are flying to Toronto, they're flying to Tijuana, and then they're walking across the land border because you don't have to test if you drive across the border, only if you fly. So it's gotten insane. And given the workarounds, it's about time this happened. And we think it's going to have huge positive effects on international travel right into the fall, which brings up your other point.
Right. Well, that's exactly where I wanted to go, Helane. I mean, basically, you could argue, do we really need that much more demand if the sky is the limit when it comes to how high airline tickets can go? Capacity isn't increasing, and airlines are getting filled up everywhere they go. Helane, at what point do we start to see some of the price increase cool off?
Yeah, that's such a good question. I was at a dinner a couple of nights ago in Chicago, and I was talking to a couple of airline CEOs who were also there. And our concern has been that demand destruction will occur after Labor Day when people realize how expensive things are and they kind of run up against budgetary considerations. And to a person, they said they're not seeing any signs of weakness in travel or any pushback on price, which I find a little difficult to believe, especially because Southwest has had a 3-day fare sale going on. I think today is the last day of 40% off fares for the fall. So that says to me there's a little bit of concern. They may not be willing to admit to it yet, but I think it's out there. And so we're a little worried. Go ahead.
Just real quickly here, Helane, how much of this is being driven by business travel, people getting back out to conferences, a shift away from simply leisure and discretionary spending?
I think that's what we have to see now. And yes, I think that we are starting to see that business travel improve sequentially, especially as people return to office. Being in the airports the last 2 days, they're packed, and it's a combination of leisure, but a lot of business people, a lot of suits, which, I thought kind of went away, but no, people were dressed and clearly they're working. So I think to your point that conferences are driving demand is certainly there, and we expect that to continue. But to your earlier point, I don't know where we're going to put all these people. It's wall-to-wall people in the airports. The planes are packed. The demand is really high. We don't have capacity, and yet every airline manager will tell you we're still not back to 2019 revenues. So they think there's room to go to the upside, and we'll see.
Helane, Becker, thank you so much, as always, for joining us. Coming up, the market-moving events that you need to be watching. That's next in our trading diary as we look at markets. Pummeled by a hotter-than-expected inflation read, NASDAQ getting absolutely hammered, down 2.4%. A regain in that relationship where tech stocks are losing more than the rest of the market, considering their rate sensitivity. From New York, this is Bloomberg. Less than a half an hour into the trading session, and the losses are deepening as markets digest that hotter-than-expected inflation read coming in at the hottest level going back 40 years. The losses are particularly acute in the NASDAQ, down 2.5%, whereas the S&P down 2%, driven by the front end of the yield curve. You can see two-year yields surging on the heels of this report, almost to 3%. Time now for the trading diary, what you need to be watching through the next week. Michigan's consumer sentiment survey coming at the top of the hour. President Biden addressing inflation in America from the Port of Los Angeles at 1:45 Eastern. U.S. PPI on the calendar next Tuesday, followed by a trifecta of central bank rate decisions. First, the Fed and Chair Powell news conference on Wednesday, the Bank of England on Thursday, and finally wrapping up the week with the Bank of Japan on Friday. This was the countdown to the open. This is Bloomberg.